slides to summarize it for those of you who weren't here, which is like pretty much everyone.
I think you're just taking jabs.
It wasn't just at you, but I'll definitely jab at you. I thought you were going to show up today after asking me to meet after class.
I was really close to that comment. It's not you. It's I have
It's 8 a.m.
lifting. It's not just that. I have lifting Tuesday, Thursdays at 7. So I have to get up for that. And then Monday, Wednesday, Friday, I have to get up for this. And man, it just takes a toll on you, whatever. You get 3 hours of sleep on the weekends.
Yeah. I feel you.
I know you do.
All right. So during for those who weren't here, I wore an awesome Halloween costume in class.
What were you?
Just like some dude going to a disco. So a 3-piece powder blue suit.
Oh, you were talking about.
Yeah, that I bought in a thrift store. So it was like
You said,
legit
yeah,
from the
I wore
70s.
those whenever he was.
Yeah. I
You
wore
were
this this like crazy wig. I felt really weird like trying to be serious all day long dressed like that.
You ever read one of these?
A Bloomberg?
Yeah.
Yeah.
I've never read one.
I
It's kind of cool.
thought there was like a joke coming or something.
It's like Halloween. Yeah.
All right. So during the financial crisis, the Fed had to, once they reached a zero lower bound, where interest rates were, or the federal funds rate was just above zero, they couldn't go any lower. There was nothing else they could do with traditional monetary policy. So they had to step out and do different things to try to continue to provide relief to the economy. A recent, like a brand new study I read a couple days ago, I came across, was that the natural rate of interest, what Fed economists refer to as R star, but that was actually -1 through most of the recession and the recovery. So that's a completely neutral monetary policy that it's not too contractionary or too expansionary. Obviously, there's no way to figure out what that is. You just have to kind of estimate it. But like a top Fed economist said, it was like -1, saying that once we reach a zero lower bound, the Fed needed to do more in order to provide the proper relief to the economy. And when we get more in depth on what happened in the financial crisis, we'll talk about some people that said the Fed, despite all their large-scale asset purchases, were still too contractionary, that they need to go even further. The first thing they did was provide liquidity during the crisis itself. So when banks were unable to lend to each other, or unwilling to lend to each other, because they feared each other's solvency, the Fed stepped in. First thing they did was expand the discount window. So they made it clear, they communicated to market participants that they would be willing to lend to anyone in the discount window. And then they lowered the discount rate by 50 basis points and then another 25, at some point early on during the crisis. So it was basically right above the federal funds rate, which is very rare. Normally it's up higher to penalize someone for not trying to go to other banks. They opened up new lending facilities like the term auction facility and then other new lending programs. If you're really interested in your textbook, they have a list of like 10 or 12. They expanded to different counterparties, so they'd be willing to go to not just primary dealers. So I forget the number, just the small number of counterparties they normally do open market operations with. They would go to other commercial banks and other investment banks. They would do lending to like insurance companies that were offering, let's say, insurance policies on the investments that were going bad during the crisis. What they didn't do was helicopter drops. Milton Friedman talked about this. Several other economists have talked about it since. Basically just giving everyone money. If the goal during like a financial crisis or any sort of recession is to stimulate aggregate demand, just give people money, that'll stimulate aggregate demand. So the idea is literally to like fly a helicopter over town and just drop money and let people pick it up and then spend it. It wouldn't be that disorderly. They would probably just like add it to bank accounts. But that's like the basic idea. Because the Fed couldn't engage in typical open market operations anymore, they also jumped into large-scale asset purchases. So these are trying to influence interest rates in other markets besides the short-term treasury market. So the first new large-scale asset purchase was called the Government-Sponsored Entities Purchase Program. Since then, we've started calling it QE1. But at the time, that was supposed to be the only one. In that, they bought 125 trillion mortgage-backed securities. So these are from Freddie Mae and Freddie Mac. These are the two government-sponsored mortgage providers. Basic idea, for those that don't know what a mortgage-backed security is, mortgage-backed security is basically like a bunch of people take out a mortgage on their homes. A bank bundles a bunch of those together and sells it to someone else. So it's basically like buying an annuity. So you buy that, or really like any other asset, you buy that from a bank, and you're getting paid those mortgage payments monthly. But it's considered, or was considered, a lot less risky because you've got hundreds of mortgage payers like paying you each month, and you get a little slice of like each one. So if one defaults, two defaults, you're not screwed. Like, you're still getting most, if not all, the money. When a lot of people start defaulting, that's where we solve the problems. So the purpose of QE1 was to provide relief to mortgage lenders, so that take the toxic assets off their books, so that they'll be willing to lend money to firms, especially to people buying new houses, because the housing market collapsed during the crisis. The next was quantitative easing 2. And this one, they purchased $600 billion worth of 6 to 15-year treasuries, while also selling short-term treasuries. Obviously, there was no more downward pressure they could put on short-term interest rates, so now it was time to put pressure on long-term interest rates. And what it did was, we talk about the yield curve being flat now. Is this really the only marker? You guys even see that?
No.
Okay. I'll just use my hand. So basically, this is the yield curve in normal times. Short-term interest rates down here are like 0. Longer term are higher because there's more uncertainty or potential for inflation. So in quantitative easing 2, they put downward pressure on long-term interest rates, bringing it like that. So now if you want to borrow for 10 years, it's now relatively cheaper. They did this through treasuries, but through treasury it leaks out through like the rest of the financial markets. One of the reasons why the yield curve was inverted so quickly recently, even though it doesn't seem that we're headed towards a recession, we're getting like the warning sign, is because it was so flat during the recovery.
So, I have a question. Our Fed challenge and what we're trying to say.
Yeah.
Aaron walked up to me yesterday. He goes, so I was looking at my slides, and I think I'm going to say that there's going to be a recession soon. I was like, you can't say that. You can't say that. It doesn't go with our PowerPoint. He's like, I have to say it. That's what the data's telling me. I was like, Aaron.
Sounds like Jenny Yellen, a very data-driven approach.
Since when does data ever tell you anything? You know what I mean?
Well, you don't phrase, or he shouldn't phrase it. Well, we can talk about some car on the way down. You don't say a recession is imminent because of these slides.
Yeah.
But he can easily say these are typically the warning signs of recession, and these are potential headwinds we're facing.
I told him to say something that
Yeah.
would not. That.
Despite the overwhelming abundant, like, positive evidence.
Yeah.
Although, to be fair, the Fed doesn't know what's going on right now. They're not 100% sure, so
What do they ever?
it's all just downside risk. Like, we need to
I think by
loosen the downside
2010 they
risk.
knew something was up.
Really?
Wait till we get into the financial crisis, and you.
I told him to
I'll
say
just quote some of the Fed minutes during the crisis. We're really concerned about inflation right now.
I told her to say, like, there are risks, but due to the recent policy adjustment, the Fed has made moves to provide meaningful support to the economy. which
That's a good phrase.
Combat.
Meaningful support to the economy.
Yeah, you like that.
And I like the recent Fed just quoting that they've been cutting rates.
We'll see if he says that, but I told him
Yeah.
to. I bet she says, for a second. Next one.
I'll
Okay, Aaron.
Good thing is you guys can just lie to me about it. Because I'm not going to be in there.
And to eat the minutes for our scorecard.
They probably won't say that, like, Aaron completely contradicted the rest of the team.
Equals.
So next comes QE3. And obviously there was some gaps between QE1 and QE2, and QE2 and QE3. Unlike the first two, QE3 was open-ended. So they said we're going to provide support to the financial market until things get better, basically. So there was no set amount of time like before. Basically what they did was purchase $40 billion worth of mortgage-backed securities each month, like QE1, and then $45 billion per month of longer-term treasuries. And they're also selling off shorter-term treasuries. The whole time while they're doing these programs, or while they're doing QE3, they're, what they call reinvesting the principal. So as these assets are like expiring, as they're coming to maturity, they're taking the proceeds from that and just buying another like identical asset. So that way, their balance sheet is staying the same size. The point was at this point was to be as like expansionary as possible, and they used clear forward guidance throughout the financial crisis, but they really hammered home during quantitative easing 3 how long they were going to continue these purchases for, and they would keep rates accommodative until there was significant recovery in the labor market. The idea was to help raise inflation expectations by telling the market that they were going to keep rates so low for so long. And then coming out of QE3, there was the financial market and like in the stock market, what they called the taper tantrum, where
Taper tantrum.
yeah, do you remember that?
Like taper tantrum.
No, taper. So what they were going to do was taper off the asset purchases. So instead of just stopping all at once,
Well, I do remember that.
cut down from 40 billion a month of mortgage-backed securities to like 30 billion, or probably like 35 billion, or 30 billion, down. So they like eased out of their like expansionary policy instead of just cutting all at once. When the Fed first adjusted forward guidance to make it clear that it was like very soon that they were going to start tapering, the markets freaked out and the stock market tanked that day. So the Fed was more accommodative for a little bit longer after that. At the Jackson Hole, so every year in Jackson Hole, the awesome like ski lodge place in Wyoming, the Fed holds a conference about monetary policy, and like all the biggest names are invited. In 2000, I think it was 2009 at Jackson Hole, Bernanke gave a speech talking about quantitative easing and what they were trying to do. And one of the goals was to support asset prices, and specifically like the stock market, because the stock market tanked. I think the S&P went down like 36% the year before. So what they want to do was provide support for that, because think of how many like pensions are tied up, people's wealth is tied up in that for their retirement. The idea was if you help support that, increase those prices, people won't feel so poor, they won't feel so worried, so they'll spend more money. It's called the wealth effect, that people, if they perceive that they have more money, they'll be more willing to spend. At this point, when they're just trying to do whatever they can to stimulate aggregate demand, that would be one effective method to do it, to help with the wealth effect. So here we see the Fed's balance sheet. This is from the textbooks, it only goes up to like mid-2014. But this shows the composition of the Fed balance sheet on like the 4 different types of assets they were holding at the time. So pre-crisis, we're under $1 trillion, we're at 800 billion, and at the peak wasn't too long after that. We end up hitting a little over 4 trillion. Now it's back down to like around 4 trillion, which is considered the new normal. The Fed's actually they've been talking about buying more assets, like expanding their balance sheet. Basically because of all the excess reserves banks are holding, the Fed needs a larger balance sheet in order to engage in monetary policy. So the first thing they did let me skip to the next slide to show you. This is the Fed's overall balance sheet, not broken down. First, they engaged in like passive tightening, which was just letting the securities run off and not repurchasing them. So the Fed's balance sheet is slowly getting smaller and smaller. You can kind of see in here a slight, very slight downward slope. Next after that, they began active tightening, just outright selling assets. And that's what the Fed's been doing, I don't know, it's maybe the last year and a half on there, where the Fed's actually tightening monetary policy. So looking back at the composition, normal times, what we have is traditional security holdings, so short-term treasuries. There's always some outright lending of the Fed lending to banks and say the discount from the discount window, but it's usually very small. Normal times, they do stretch this back to like the 70s. Normal time be very small except for rare occasions. September 11th, like that day, they flooded the ton of loans from the discount window in order to provide liquidity, so financial markets didn't seize up. But besides that, like within a day or two, that was all withdrawn. Things went back to normal. Normal situations, very, very small. But here we see it starts expanding more through 2008 as banks are more and more worried. They fear other banks are insolvent, and then it spikes here. So there's a ton of just straight up lending to the discount window. And then you see over time, as the crisis subsides, there's less and less, less of the Fed's balance sheet. Here you see the start of QE1, where they start buying federal agency debt and mortgage-backed securities. And that, you see it grows at first, and then QE stops, and it stays stable for a while. And then with QE3, they begin and again, it grows. And long-term treasuries. They began purchasing some long-term treasuries early on. These were not that long-term, not this like 6 to 15 year, but they were longer than traditional. And then here in 2011, when we had QE2 start, that's when they started purchasing a ton of them. And then again, in QE3, you see it later on.
You need to teach Jason that.
Really just that?
I don't know, he's the balance sheet slide. I'm sure he's struggling.
So basically just describe like all three of these, and maybe, since we don't in our presentation talk about QE 1, 2, and 3, I'll send some information about QE 1, 2, and 3, like what the goal of it was.
So the gold sliver, that's short-term T-bonds?
Yeah. Yeah, so you see it's shrunk as a portion of the Fed's balance sheet since 2000, I guess it was 2008, like the beginning of the year. But everything else has grown substantially. And here we've got the full thing. And this was taken like a week or two ago when I did the slides. I didn't update it last night. But we have an uptick at the end where the Fed's been loosening policy again. Okay, so quantitative easing, this giant increase from 2008 there all the way up to like 2016 didn't cause 2% inflation. There was supposed to, everyone predicted like dire inflation because of how expansionary the Fed was, but like we can't even hit 2%. The recovery was sluggish, and the unemployment rate, a big chunk of the fall in the unemployment rate is due to lower labor force participation rate. So it's not that more workers are like getting back to work, it's that fewer are like trying to get work, which is not the way you want to bring down unemployment. Basically what happened is the banks have just been holding excess reserves. That's not included here on the Fed's balance sheet. I should have a measure of excess reserves.
So what are excess reserves in banks now? Is that just like paper cash?
So they can either keep paper cash like in their vaults, or they can keep it at a Federal Reserve like regional bank.
Okay.
Just as long as it's somewhere safe and it's physical cash. Yeah, because the banks have been able to collect interest on excess reserves during the crisis. Instead of lending them out, they'll just take the safe money, and it was high enough that they thought it was worth it. So it was kind of a perverse incentive, Because you want to increase lending, you want banks to take risks, and you want them to be willing to take risks. So using that old punch bowl metaphor, like the Fed gave banks a punch bowl and then kind of encouraged them to go sober and not drink it, even though they gave it to them. So they have all these excess reserves, but they're just not spending them. So you'd hope they'd be like someone like Max and actually like drink it and like, continue the party, but instead they did. And that's, so that held back growth, or held back how expansionary policy could have been compared to what the Fed's goal was. Despite that, does anyone think QE was a success? I mean, we are now in a much better place than we were before. Without the Fed doing QE, even though their policy during the crisis was not as expansionary as it could have been, because the interest are in excess reserves. Do you think without that we'd been able to recover like this?
I think some new banks would have showed up, maybe spots of old banks.
Some of the problem with that is it has nothing to do with the Fed, but
Yeah.
with like Dodd-Frank and other financial regulations that make it difficult to start a bank. It's hard because you think, the free market would just work. Like, someone sees a profit opportunity, they're going to take it.
This is the unfree money.
Yeah, but like healthcare,
unfree
the
market.
financial market is not an actual free market. So, I mean, you can talk shit on the design of like QE all you want, but without those, like, are banks going to lend?
Probably.
I think it's hard to argue that like in the crisis, when we see the spike in lending, like late 2008, like if the Fed doesn't do that, then you have a lot of banks fail, just because they're unwilling to lend to each other. So at least very early on, this stuff did help. Some of the problem is policy tends to be backward looking. So look at how much mortgage-backed securities they bought. Because they want to support the housing market, because the housing market drove the previous boom. But housing isn't guaranteed to be like the driver of economic prosperity. It wasn't always in the past. And given the demographics of where people are moving, can you buy a house in DC or New York City?
Yeah, but
I follow this Instagram account for called Coming Soon Arlington, which is just like new houses being put on the market in Arlington, Virginia.
they're ridiculous.
I got like their sponsored content from when I was trying to move down there at the end of grad school, and it was Zuckerberg listens to everything. So he knew that, so I started getting targeted ads for it. So I just followed it because it was interesting. I wanted to see how much. It's like 3-bedroom, like 2-bedroom houses, like
$1 million.
20 million or 20 miles from DC. So it's still like a hell of a commute to get in for $1 million.
Yeah.
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 And these aren't mansions, and they're not like the nicest things you've ever seen.
Like some
So-
of the houses on Main Street in Laredo would easily be like $600,000, $700,000.
Oh, in current condition.
Yeah.
With the holes punched in the wall and the beer stains on the floor. Still 600K in Arlington. But like people tend to move to big metropolitan areas now, and you can't buy houses there. So supporting the housing market, I don't know, due to these demographic shifts, may not be as important. May not be driving economic growth like it did in the past.
But it supports the world.
Yeah, we're supporting the farmers. That's what we're doing.
That's what I was thinking about.
Main Street America.
That's right, Main Street. So when asked this question, Ben Bernanke, the completely, totally partial observer, not that he like designed this and implemented and everything, he says that QE was a success. I don't know, you guys are shocked. He said it served as credit easing. So they altered the Fed's balance sheet, which they definitely altered the hell out of the balance sheet, to provide liquidity to specific segments of the credit market. So buying long-term treasuries, putting downward pressure on long-term interest rates, makes it easy for people to buy durable goods. So if you buy a house, a car,
I was gonna say that'll prop up cars, right?
Yeah.
Because
the auto
cars
market
too.
tank too, yeah.
But people aren't gonna buy cars anymore too, so.
yeah, if you're in a big city,
Bicycles, you gotta invest in bicycles.
we could spend a whole class talking about whether people are going to own property anymore or not in the future.
Somebody has to. If you're renting it, somebody has to.
Yeah, someone has to, but.
I'll own it if you wanna rent from me.
Fed will own everything, the balance sheet will be the world.
The Fed balance sheet is the entire economy. They own all the cars, and you rent the car every morning. Well, think of it. My car's sitting over there right now.
You could rent it out.
Yeah, someone could be driving it around making money.
You could.
Yeah.
That's
Sorry.
what Uber does.
Just wait until they get into stuff like that. They own their own fleet of cars. Have them doing that. But yeah, so they try to target automakers and or auto lending and home lending. Try to support that. They tried to support the home loan through the mortgage-backed securities. They're buying that. Long-term interest rates also help firms make investments and like capital improvements. So if interest rates are lower, it's cheaper for them to buy, I don't know, if you're a pizza shop, a new pizza oven. Now, maybe it's bigger, it's more efficient. So you're spending less on energy or you're making more pizzas. Overall, that's a good thing, but it's lower interest rates that help that. So that was, and obviously helping the stock market, people's portfolios recover, the wealth effect, they spend more. So these are the different ways that he tried to design QE to help these specific segments. I forget his first name. The Fed researcher Gagnon, he does a lot of macro monetary policy kind of stuff. And he found that QE, all three of them combined, decreased the long-term interest rates by 100 basis points. It's solely like those purchases did that. And obviously forward guidance would have some, additional effect. Some researchers, I think it was Kanlin Lee and Min Lee, were one of them, or one pair of them, that looked at interest rates before and after the Fed's announcement of QE. They said, all right, we're going to do quantitative easing one. We're going to support, we're going to buy mortgage-backed securities. And they looked at what happened to interest rates in like several markets. And you can see a pronounced effect based off these Fed announcements. And anytime the Fed would change their language, so during like QE3, they say we expect to be accommodative, provide support to the economy for the medium to long term, or say to long term, and they change it from long term to medium to long term. They're like, oh, they're going to start tightening soon, and you would see rates change like immediately. So forward guidance had an effect as well. Besides he just measured the asset purchases themselves. Unfortunately, like it should have boosted investments because we're talking about lower interest rates. But there were a lot of regulations during the Obama era that helped limit the amount of long-term investments, and there was a lot of uncertainty. So you have Obama saying, and like the Democrats in Congress saying, we're going to regulate this, we're going to do this, we're going to do that. You have Republicans saying, no, you're not, or we're going to undo it. So there's a lot of uncertainty. So when there's uncertainty in the economy, especially for the regulations that are going to help shape it, firms hold off on making these like expensive decisions.
So then just nothing.
Yeah, so less happens. So great, you've lowered long-term interest rates, but firms aren't gonna use it. New regulations aren't gonna prevent people from buying a new car. So there's still getting out into the economy, helping aggregate demand some way.
It's just not as much as it could be.
Yeah. And regime uncertainty. Nowadays, with our political divisions, is something that's not going to just go away. Happened all through the Obama years, all through the Trump years. Whoever comes in after Trump, it's going to happen to them. So that may be something just that ties the Fed's hand even more, that they're less able to actually have an effect. Yeah, so the Fed, when they were at the zero lower bound, they started engaging in forward guidance, trying to tell the market what's going to happen, trying to increase inflation expectations to eventually propel the market forward. So they promise low interest rates for a long time to help. Yeah, if you increase inflation expectations, a mechanism that this would work is that high inflation expectations leads to a higher salary demanded when people are going for jobs, or the demand raises each year. If I know prices are getting much more expensive, I'd be much more willing. I feel more comfortable arguing for a higher raise. Like if things were getting cheaper, it's harder to argue. Just the cost of living adjustment like aspect. As you get higher labor costs, that leads to higher prices. So that's sort of the mechanism by which it works. So they use two types of forward guidance. There's conditional. So as long as economic conditions warrant was a phrase they used. So they'd say like, as long as unemployment's super high and inflation's super low, we're going to be doing this. Once things improve, then we'll stop. We'll take our foot off the gas, so to speak. The other type they used was unconditional. So they'd say for an extended period of time. And they would make it clear that this is going on for a long time. It's a lot stronger, but it's also riskier. So if things would suddenly change, if there was a sudden bout of inflation, say banks suddenly got super confident and loaned out all their excess reserves, and then inflation skyrockets. The Fed would kind of have their hands tied there because they said they're not going to raise interest rates for a long time, but now they have to. So something we'll talk about later, the time inconsistency problem, is that they can go back on their word, but if they do that, people won't believe them in the future. So it makes forward guidance more difficult in the future. That's why you don't see Fed doing forward guidance in normal times. Like they've been getting away from it lately, especially as they've moved to actually raising interest rates, and now they're cutting interest rates again. If you think of it, they could do either. They can keep it the same, they can go up or go down next meeting. They're likely to keep it the same. But if something happened, if the trade war escalates substantially, suddenly they're going to cut rates. Or say Europe or emerging markets suddenly recover and their economies start doing well, that's one less headwind we're facing. Maybe they raise interest rates. Forward guidance gets risky when you don't anticipate those or when something that you consider low probability happens. So that's why they haven't done it in the past in normal times and why they're not going to, why they're getting away from it now. And of course, there was the fun Greenspan stuff where he said, if you understand what I'm trying to say, you're mistaken. Or he would just talk in circles and no one knew what he was talking about. That way he could do whatever he wanted. He didn't have to worry about market expectations. All right. So I know this, with all the days off and with all the reading stuff, this chapter took a while. Do you guys have any questions about the tools of monetary policy? All right. We've got 12 minutes left. Do all you guys have the book?
Yep. I mean, not
Yeah, I mean, like, do you guys like own it?
No,
Never go.
yeah.
I ordered it and it never.
I have a different book that has the same name.
Well, you happen to have it, or you just bought a cheaper version, or?
I went to the library and they said they had the book, and then I realized about halfway through the semester that it wasn't the same book that you were talking about.
Do they have a lot of textbooks over there?
Yeah, that was a good amount.
That would have been genius. I only bought like half the textbooks when I was an undergrad. You should, like, I would wait till like the first class we go over the syllabus, and normally they would say like you're going to need the textbook, or you could figure out that you didn't have to read that much. And based off that, I'd buy it or not. I was just curious. I don't know if you really need it for this class. It always helped me to like go over and like read it like either before or afterwards, so I knew we'll like dug it in a little bit more. Okay, so next we'll look at financial crises. So financial crisis, that occurs when there's a large disruption to what they call information flows in the financial market. So what basically happens is financial frictions increase sharply. They're always present in the market. There's always uncertainty and there's always transaction costs and I don't know, buying or selling assets or borrowing or lending. But they get really bad during a financial crisis. So bad so that the financial markets pretty much seize up and stop functioning. So during like the financial crisis, you saw interbank lending basically stop at points because they were so concerned about the solvency and the health like other banks. A lot of this, I've augmented stuff that they have in the chapter with information from Manias, Panics, and Recessions by Charles Kindleberger.
Read that.
Did you have Whistler's?
What?
Whistler's class?
Yeah.
Yeah. That's where I had it from too.
Is he still around?
He's not.
He's not?
That's a shame. He was an awesome professor.
He's pretty smart too.
Yeah.
London School of Economics.
Yeah. And he would just like talk. He'd like be casually like chatting, but it'd be like about like hardcore information like this.
Oh, yeah.
Just like off the top of his head. And he's speaking in like full paragraph form, complete sentences, like super like big words.
Where's he at now?
I have no idea. He left like right like days before I started.
Really? What's
Well, he didn't leave.
Escorted off the premises.
Yes.
In a while, they would bring campus police to do that. But Kindleberger's book, Manias, Panics, and Recessions, is like a. I was gonna say it's a gold standard, but that's a bad pun. But it is like it's one of like the main books you go to try to understand financial crises, and it's. I don't know. I'm not gonna make you guys read it in this class because it's just a lot of extra reading. But it's not full of like econometrics or like fancy jargon. It's more of like a history of like how these happen, and he brings in theory like of how crises, the anatomy of crises, like throughout the book. So it's a much easier read than you would expect from something on financial crises. But I thought his treatment was a little more in depth than what Michigan does in the text. So here's a quote here that I'll just straight up read. Some event changes the economic outlook. New opportunities for profits are seized. Overdone in a way so closely resembling irrationality as to constitute a mania. Once the excessive character of the upswing is realized, the financial system experiences a rush to reverse the expansion process so as to resemble a panic. Basically, something new happens. And it can be anything. It could be people suddenly decide that tulips are super valuable. It could be we found a way to securitize mortgages. It could be the belief in the 1920s that the stock market is never going to fall again. Something just substantially changes. And once those change, there's new opportunities to make money. You can make money buying and selling tulip bulbs. Or you can make a ton of money buying mortgage-backed securities. Or providing insurance policies on those mortgage-backed securities in case people default. Overdone in a way so closely resembling irrationality. Eventually, that's all people can talk about, and people that know nothing about the market are getting involved. Suddenly, your uncle or your grandma is talking about Bitcoin. And any sober observer can look and see the price increase and think, this doesn't seem right. What's going on here? But everyone involved is just seeing the prices go up and think, oh, I can buy a little bit more and then sell it a little bit later, and I can make just a little bit more money. So it appears that they're acting irrationally. Whether they are or not is a question, but from the outside, it looks like it. Eventually, something happens that people realize that people involved in this market realize that it's crazy, just like the people watching from the outside. Suddenly people say, I shouldn't have mortgaged my house so I could buy one tulip bulb. This isn't like a South Park joke. This is like a thing that happened.
That was Netherlands peoples.
So eventually, everyone realizes that this is bad, and they try to get out of their position, lock in their gains, and just take the money and run. Unfortunately, everyone doing that at once, it looks like a panic. And if you can imagine like the New York Stock Exchange, like in the old days when all the traders are on the floor with like sheets of paper to like write their trades on, like screaming at each other, it would literally look like a panic. You guys ever seen Trading Places?
Yep.
Have you guys seen it? With Eddie Murphy and
Yeah.
Dan Aykroyd.
Yeah.
I love their them showing the old stock market.
That's what I thought it was gonna look like when we went there.
I know, I was so disappointed. When we went there, the one guy told us like this is not like the old days. Like it's all computers now. So it's like one or two dudes at a terminal wearing like they have like the
Still
suit
really
jackets,
small.
but they're like mesh.
Yeah.
It looks like a penny you'd wear to like practice in. Yeah, it's really, but it's so hot in there. Like they said, they have to wear it. But they're standing at a computer terminal with like 50 monitors. Where in the past it'd be like 50 or like 75 people, like all jammed in there with big notepads. I think if you imagine when the price of frozen concentrated orange juice started dropping, that's sort of what the panic idea that he's talking about is. People just start rushing and they need to get out of there. So here's some historical examples of financial crises over the years. The first real bubble in modern times is the tulip bulb mania that took place in the Netherlands. How true the conventional stories of the tulip bulb mania are is up for dispute. Some of the contemporary sources say that it wasn't that bad. They like list like the price increases and prices got too high and there was somewhat of a crash, but it wasn't the insane recession or the insane panic that later sources wrote about it as. But again, that's still up for debate right now. Next was the South Sea bubble. That involved primarily England. I don't think I wrote it down.
I wonder how big it was.
It was still pretty decent size. That
It was in a sea.
Well, it wasn't literally in the sea that it took place. It was the South Sea Company. And this was early on in like the formation of joint stock companies, and in like still somewhat early on in the age of imperialism. So, I guess a mania forming was, I don't know, shouldn't be too surprising. And it was still like a newer thing. And there was a Panic of 1825, which also took place in England. And a lot of these didn't just, like the tulip bulb mania just took place in the Netherlands. But these other ones took place in like larger and larger areas, and over time became more and more connected as banking systems became more connected. Like 1825 took place in England, almost like brought down the Bank of England, but it had, I think France was like the next most hit country. There was still some effects in other countries from that. Next was the Panic of 1837. It was called Van Ruin's Depression. Martin Van Buren designed his own political party. Took war hero Andrew Jackson to be the first president of his new party. Because everyone would love Andrew Jackson and would get him voted in. Even though he didn't have they didn't have the party mechanism in place that a relative unknown would need to get elected. So he's his vice president. Andrew Jackson kills the second bank. Does a few other policies that aren't good for the stability of the banking system.
This piece is circular and stuff.
Gets out of office. Martin Van Buren gets in, and right afterwards there's a depression, and he gets blamed for it. Only served one term because of that. I think it's ironic how we tried to set up a political dynasty and just shit the bed.
There was a lot of Democrats in there for a while.
I mean, he didn't. Yeah, he created the party, so the party is not like it didn't last for a long time. Didn't help him out though. If his only goal was to be president.
Well, we had really weird hair.
Yeah.
They all had weird hair back then. You ever look at the pictures of robber barons? I guess it was too risky to shave your neck back then or something. So many that had their beards down here on their neck, Or like they would shave their face and they would just stop right at their jawline. And like down here would be all hairy. Yeah, and these are like the richest people in like the 1800s. And these dudes are walking around like that. But I guess when you're that rich, like no one can like talk shit on you, right?
Guess so.
Like who's gonna like bully you when you can like buy or sell like someone like bullies you, just buy their house and kick them out. Or buy their company and like get them fired. All right. Next was the Long Depression from 1873 to like 1896. In the United States, there was a series of financial panics, and there was deflation the whole time. And we talked about this in Money Free and Unfree. It was just a bad time. Despite massive population growth, and the economy actually getting much better over that time. Like the goods and services are being offered are of much higher quality. Some of the deflation was due to gains in productivity. Some of it was due to a sharply decreasing money supply, thanks to the federal government retiring the Civil War debt. Next is the Great Depression. Lasted from 29 in the United States till, I put question mark because when we got out of the recession or the depression is still up for debate. It's hard to say World War II was a recovery because people's lives were like so much worse and we didn't spend any money. Our GDP rose because we were spending money, the federal government spending money on the war. But does building tanks and bombs, is that a true way to measure the health of an economy?
Yes. Soviet Russia is.
There were jobs.
I mean, there were jobs. I mean, they're going over to Europe and dying in fields, but
Well, people had to make the tanks.
people did have to make the tanks, but it didn't make people better off. After the war ended and people came home, spending took off from what they call pent-up demand. They wanted to buy all these things, but they physically couldn't. And by the time they were in the war, they had the money to again, but they couldn't. They come home, and then suddenly life's better. Things take off, and we went from nothing for a while to. And finally, the financial crisis. Last example. We lived through this, so you need less explanation for it. But housing market boom funded by low interest rates and encouraged by federal housing policy. Combine that with banks creating new financial instruments. You have a great recipe for mania. So we'll end there. Next time we'll start talking about the model of financial crises.